I don't know that we would want a 3% rate now, because obviously a 3% rate financially would be incredible and we'd love to see that again. But what would actually realistically allow us or cause us to hit a 3% mark again these days? In my opinion, it would be something very significantly, negative in the news, a World War III type headline. Last Thursday afternoon, the administration announced a 200 billion with the B dollars worth of MBS purchases.
Welcome back to another episode of Facts, Figures, and Fallacies from the Front Line. This is our podcast, and today we're very excited to have Jeff Sicking back today. Jeff is a mortgage loan officer with American National Bank and Trust. He has over 20 years of experience in the industry, and he specializes in investment, property financing, and custom home new construction. And so we're just really excited to have Jeff back on. If you're watching this video for the first time, check out the previous video we did with Jeff a few months back for some great info. But in today's episode, we're excited to kind of touch base on how things have changed since our last meeting in the market. And Jeff, how are you doing today?
Man, doing great. 2026 is off with kind of a bang so far. So it's
Yeah,
been a good year so far.
yeah, definitely. Well, in the past 5 months since we last spoke, has anything surprised you in terms of like changes since that point in time?
Sure. I would say really no just major curveballs or surprises in as far as in the mortgage markets and real estate markets in general. It's been a relatively calm, you know, environment. I would say a relatively flat environment as far as just the rate market and the as far as the actual housing side, it really hasn't been too hot or cold. It's been fairly steady, I would say, from what we're seeing on the front lines.
Hmm.
So just kind of sometimes boring isn't bad though.
Yeah, that makes sense. In the last video, you mentioned, you didn't really see that 3% rate coming back anytime soon. So that kind of, you still feel that way?
Man, I do, and I probably even feel a little more convicted that that's the case now than I did, last summer. I get that question a lot from agents and from potential borrowers. And then a lot of times the way I look at that is I don't know that we would want a 3% rate. Now, let me explain, because obviously a 3% rate financially would be incredible and we'd love to see that again. But what would actually realistically allow us or cause us to hit a 3% mark again these days? And in my opinion, it would be something very significantly, negative in the news, a World War III type headline. Somebody would have to drop a nuke somewhere, or you know, the last two examples we have of 3% rates were a worldwide pandemic, and at the middle of it, we didn't know if any of us were going to be here in a couple of years. And then you look back to the '08 crisis, which I do have a full head of gray hair, and I'm old enough to have lived through that on the front lines in this business. It was really scary back then. The markets completely locked up. Nothing functioned normally for, a long time. There was no market for lots of securities, and it really questioned the core fundamentals of our markets. It was, it's probably close as hopefully we'll ever see to the Great Depression in my lifetime.
Yeah.
So point is, it takes a really serious, really, really extreme event to cause an extremely low rate like three. So I know that's a long answer to a simple question, but I would say it's fairly unlikely at
Yeah.
this.
No, that makes sense. I mean, I definitely don't want to go through another pandemic just to have lower
Yeah,
interest
right.
rates. So I get
Absolutely.
it. Do you feel like customers or, home buyers have kind of shifted their expectation with that a little bit, and they're starting to just get used
I
to these higher rates?
I would say slowly but surely, very slowly but surely on that, Nick. I feel like more people, this last quarter or two have maybe come around on that to realize that, hey, we were at almost 8% a year or two ago. And I don't want to get too far ahead of myself, but, recently we're kind of in that 6.0 range. So we're almost a 2%, you know, dip from where we were at the highs in this cycle, which is not insignificant. That's a lot of money when you talk a six versus an eight. So I mean, we're in a lot better spot than we were a year or two ago. So I think a lot of folks are coming around to realize that, a 6%, flat or even a high 30-year fixed rate is not a bad rate at all, relatively speaking.
So Jeff, do you feel like this is as low as we'll get? And if anything, we'll start bumping up again Q3, Q4 of 2026?
The short answer on that, Mitzi, is no. And one of the biggest factors that I think is driving that is the fact that we've got the midterms coming up, and I hate to be a political, you know, kind of guy and get into the politics of all this, but in reality, it has an effect, right? Trump's administration kind of teased the fact that they were going to have some big things coming out this year back in December, and they led off with their institutional ban on buying investment properties in an attempt to try to bolster more inventory for would-be homeowners. I think that, just me, Jeff's opinion here, that's just political shenanigans that really doesn't really at the end of the day boil down to much in most of our markets. I think last time I looked, the guys that qualified for that or 1,000+ threshold, it was like 1% 1 to 2% of the DFW market, very insignificant. So nothing really significant there. However, last Thursday afternoon, the administration announced a $200 billion with the B dollars worth of MBS purchases. So I did want to talk about that a little bit because it's a big number, and it's had a very big impact on the market so far. So that gives us cause for a lot of optimism over the next quarter or two as far as where mortgage rates are headed. So
has that already taken place? Have they began buying the mortgage-backed securities?
So this kind of quietly started about the time of our podcast last summer, about 6 months ago. They essentially, and when I say they, the administration prompted Fannie Mae and Freddie Mac, which, just to recap real quick, after the GFC in '08, they basically were taken over by the U.S. government. So us taxpayers are the primary shareholders of Fannie Mae and Freddie Mac. And about 6 months ago, they started buying additional mortgage-backed securities on the open market with excess cash reserves that they held on their balance sheet. So what that caused to happen was, if the market's, even here, if there's 50 billion of additional demand or buyers for those securities, that's going to drive the prices of those MBS securities up, which, when prices of a security go up, the rates, or the yield, if you will, go down. So we've already seen a little bit of that over the last 6 months. I would argue that that's had as much or more of an impact on interest rates than the Federal Reserve's, quarter point rate drops that we've seen incrementally over the last 3 or 4 meetings. Just
So
because that's
just for
oh, yeah, go
comparison. So 200 billion of mortgage-backed securities, say beginning 6 months ago. How does that compare to? Didn't they do that in '08 as well?
They did, and I didn't have time to research what those numbers.
Okay, I just wondered how it
Yeah.
compared, because 200 billion
Yeah,
didn't seem like a whole lot.
it's not you're right. It's not a huge number comparatively speaking to the, during the COVID and during the GFC, quantitative easing period. It was in the trillions, and we're talking, it was basically 50 billion over the last 6 months. And then just last Thursday is when the 200 billion number was rolled out. So to my knowledge, they have not actually started, gone to the market yet and physically started buying those securities. It was just announced Thursday afternoon, but just the headline news on that essentially pushed mortgage rates down almost 0.5%. So
Wow.
just the headline effect was significant. And normally in our industry, a lot of times you get the brunt of the benefit from something, upon the news release.
Right.
It's almost an immediate impact on the market. Kind of like we talked about last time, how just because the Fed's lowering rates a quarter today, mortgage rates won't drop a quarter. That was baked into the cake a long time ago. So there's a little bit of that going on here. But the thing that is different about the MBS purchases, as opposed to other headline news, is that there is still a little bit of benefit to come. And this is just in my opinion, from the pure market fundamentals of whenever, they send an issuance this week or next week or whatever for 10 or 20 or 30 billion extra in MBS assets that are going to go to the Fannie Mae and Freddie Mac balance sheet. That demand will additionally move, MBS prices and positively affect mortgage rates. I am predicting. So I
When you
think we've
say,
already seen some of the benefit, but I do think there's additional benefits to come from that.
okay.
Just
And so when you
with the
say
way
mortgage rates, are you speaking specifically about residential, or would that be residential and commercial?
So when I'm talking mortgage rates, I'm strictly talking residential, really focusing on Fannie and Freddie, which are the sources of pretty much all conventional loans these days. That's the end source of funding or where the rates really come from. FHA, USDA, and VA, the three government type loans, basically fall into the same category, and they'll move in line with Fannie and Freddie's conventional rates, and equally benefit from this, as opposed to the conventional market. I don't think you're going to see near the impact on the convention, or I'm sorry, on the commercial market. What I meant to say, the commercial market's going to really be hinged on the 10-year treasury, the SOFR rate, and even the Fed funds rate. I refinanced a commercial property last week, and it was tied to the Fed funds rate. So a lot of this is, I don't think, going to have a huge impact on the commercial market. I think politically, the administration's main goal is just their push for affordable housing, and just really focused on the residential sector of the real estate market.
Okay. So you said they limited the buyers, no large institutional buyers. And then the
Yes.
mortgage-backed securities purchases. Did you say there's something else in the works?
So not that I know of. I mean, it wouldn't shock me if they rolled out some sort of, one-time lump sum tax credit of some sort for first-time home buyers. That's what they did in 2010, 12, somewhere around in there, a couple years after the GFC, to try to pull the market out of that. That wouldn't shock me at all. But, I don't know what else they could do at this point. I will give them credit. I think the GSE purchase idea for the 200 billion this year is a great idea. It's not going on the Fed's balance sheet like it has in the past. This is something that's strictly a Fannie Freddie thing. So it's essentially not, increasing the government ownership of these private markets. So, it's not near as, crazy in my mind that we're just printing money here to go fluff up a market or prop up a market like we have in the past, honestly.
So Jeff, in North Texas specifically, are you seeing any trends such as the inventory, pricing, the demand? I know we have a lot of people that are continuing to move to this area. So how's that looking?
I would say that buyers today have, probably the best level of inventory to choose from, in recent years. I mean, I'd go back to, as far as 8 or 10 years, as far as just a good, solid level of inventory. I think depending upon which market metrics you're looking at, most DFW markets are probably anywhere from 6 to 8 or 9 months worth of inventory, which, you know, most experts say 6 is about a balanced buyers and sellers market. So the scales are favorably tipped in the favor of buyers, and that there's a couple months over the what they call balanced 6 month level of inventory, meaning you should have ample choices of finding the home you want and being able to negotiate a better deal than you would otherwise.
Yeah,
So
and we're in Wise County, and I know in the past the inventory has been, pretty rough, right? But now
yep.
they're building some new subdivisions. I know there's a new one coming off 380. Some apartments have started coming in, so I feel like we're kind of on the up and up as well with the inventory, right?
I agree. I mean, I feel like there's definitely some pricing pressures on rent in Decatur for the first time that I ever remember in 16 years living here. I've heard that firsthand from some of the multifamily guys that manage a couple of the multifamily properties around town. Decatur's always been so tight on inventory. Landlords had the leverage to price a house or an apartment at an exorbitant amount, and folks just kind of had to pay it because that's all there was, and that's definitely not the case going forward. And then, with the recent addition of D.R. Horton's neighborhood behind Walmart, and you mentioned Paloma out on 380, and there's a couple others a little further out, I guess. But as far as just timing of coming to market, but there's definitely not going to be a shortage of residential lots to build on in the next, over the next couple of years. There's thousands of lots slated to hit just the Decatur zip code over the next couple of years, and we've never seen anywhere close to that volume of lot inventory hit the market.
So you
Yeah.
would say for the next couple of years, it's a really good buyer's market and possibly some lower interest rates on residential mortgages?
I would definitely say yes to that. I mean, as a buyer, I think you're gonna have more choices, especially in that entry level market. If you're looking, in that, call it 250 to 350 range, you're gonna have 10 times more choices in a year from now than you did 5 years ago. I feel pretty safely saying that.
Nice. Are you seeing from especially like first time home buyers or these people trying to get in at that maybe that 250 to 350 range that you mentioned, what strategies would you say are best for them, like rate buy downs, just trying to time it the right way? What do you see a certain strategy that you'd recommend, or even just that you're noticing a lot of people are pursuing?
Sure. Yeah, I mean, the rate buy downs, permanent and temporary buy downs have been kind of the buzz the last year or two in mortgage and real estate in general, especially in the new home, especially in the first time buyer, new home arena. I personally, if I went to go buy a house today and it was my first home and the builder was offering crazy incentives, I would probably elect to take those via a price drop versus a ten or $20,000 concession towards buying an interest rate down. My theory on that is, you can get a pretty good interest rate right now at a par rate without having to buy, the ten or $20,000 buy down fee. Take the lower price and then just monitor the market. There's a really good chance you may be able to refi down to a even lower interest rate over the next year or so. And instead of paying a ten or $20,000 discount fee, you might pay two, three, $4,000 in refi costs. So it would be a significant, better deal for you. Plus, at that point, you've lowered your basis in the house by, ten or $20,000 potentially.
Yeah,
And
that's
Jeff,
good.
when you recommend a refi, would you recommend that for 1% or more of an interest rate decrease?
Great
What's your-
question, Missy. So yeah, I wouldn't say there's a general blanket statement like that. That's always an exact science really there. But the general rule in our business is we look at a break even point. So we figure if the cost is X and the savings is Y per month, just do simple math. What's the break even? How long does it take me to recoup, say, that $3,000 upfront refi cost if it's going to save me a hundred bucks a month? So it's, in that scenario, it'd be 30 months. That's, in our opinion, probably too far out for most folks to justify. We love to see a break even point. Obviously the shorter the better, the quicker the better, but we love to see it in that 12 to 18 month range. When you get beyond that, in my opinion, it gets really hard to justify, especially beyond that 24-month range, just because you're taking that long just to pay for the refi before you actually put one net saved dollar of interest in your pocket.
Right.
Yeah.
So
Is-
the one
is
percent
there-
rule is, and the 1% rule is probably good to say in that two, three, $400,000 range. When you get into super high loan amounts, pushing $1 million, it might be worth it at 0.5%. And then
Right.
on the flip side of the coin, if we're talking $100,000 or $200,000 loan amount, we might need to save closer to two to justify it. So.
Okay. And refi costs, can you put a percentage on that?
Yeah, so the biggest cost in refinancing is generally going to be the title policy fee. Not an exact number here, but it's going to generally run around 0.75%. So if you add, the mortgage fees in there, an appraisal fee if one's needed, 50-50 chance probably if one would be needed or not. I would say on average your refi costs are going to run around 1 to 1.25% of the loan amount. So $300,000 loan is going to cost around $3,000 to $4,000 to refinance in true hard closing cost.
Okay. And you can shop
Which
those,
could be
right?
rolled. Absolutely. Yeah, you can shop that. And a lot of folks, if you were to shop it, really, in my opinion, it boils down to two things. Everybody's obviously focused on rate. That's number one. But what a lot of folks don't realize is, what's the cost of the refi? A lot of us local companies don't charge an origination, fee or points. Most of us and our local competitors do not. If we're going to quote you a fee, it's just our par rate, or quote you a rate. I mean, it's just our par rate. As opposed to if you go to all the online.com lenders, they're going to quote you an extremely attractive interest rate, but you don't realize it until you get more of the fine print in the paperwork. A lot of times they're charging a 2 or 3 or 4% discount fee to buy that rate down. So on a $300,000 loan, you're talking, $6, $9, even $12,000 to get that rate. And a lot of times that's just not a good deal, but that's kind of their whole business model. So you got to really watch, obviously rate, but the thing a lot of people miss is fee as well.
Jeff, are there some like common misconceptions, anything you'd tell like a first-time home buyer, maybe somebody who wants to, in their head, they've been renting, and they don't have that 20%, for example, so they just kind of get in this perpetual renting cycle, and they just feel like they can't break through and buy that house. Any misconceptions or advice for somebody like that?
Absolutely, Nick. I mean, really, the only reason you'd need 20% to put down on a residential home is if you were buying like an investment property. Our down payments on those range from 15 to 25%. But that's if you're buying a rental property. If it's a home you're going to live in, conventional, standard, just plain Jane mortgage, route, you're looking at 5% down. If we were to do a government loan, a VA, USDA, or FHA loan, those run anywhere from 0 on USDA and VA to 3.5% on an FHA mortgage. Just interesting fact about Wise County, even with our growth, we're still classified as rural with USDA. So pretty much all of Wise County, except for that very southeastern little corner that's in Fort Worth, pretty much other than that, all of Wise County qualifies for USDA financing. I ran some numbers before we hopped on the podcast today, and USDA just, for an FYI, is running around 5.5 on a 30-year fixed rate, and that's with 0 down. So a lot of folks don't realize that all of Wise County qualifies for that, and it's an incredible loan. The PMI is very favorable. It's just a really good loan, and we're fortunate here because we're still classified as rural to fit in that USDA box. So definitely don't let the down payment be a deterrent.
Yeah.
And Jeff, you did mention PMI. Is 20% the down payment if you don't want to pay the PMI?
Yes, that is correct. One thing I'll also say with PMI, those PMI companies have been just aggressively competing for market share the last couple of years. Plus, their loan loss reserves have gone down significantly. They haven't lost the money that they did, 10, 20 years ago during, financial, crisis type situations. So the premiums on PMI are half to a third of what they used to be a couple of years ago. So, it's not near as ugly, if you will, as it used to be back in the old days.
Nice. That's
This
awesome.
would be a good time, Jeff, for you to go ahead and update us on your company, what your role there is, the types of mortgages that you run there.
Sure, absolutely. So I'm with American National Bank and Trust. We're headquartered out of Wichita Falls. I manage our local branch in Decatur on the square, and we essentially offer full, banking and mortgage services here at our branch. We recently opened deposit operations here a couple of months ago. Brad Rieger is our deposit ops branch manager. So stop by and see Brad if you have any, banking or CD or any sort of depository questions. On the mortgage side, Kristen Ripple in our office is our land and construction loan specialist. She's been in Decatur almost 20 years, solely pretty much doing land and construction financing. She's the guru of that. She probably has originated more construction loans in this county than anybody, and is here physically in our local office to help with that. And does a ton of them and does a very good job. And then my partner, Megan Hood, and basically focus on the secondary market side of the mortgage end. So like if you were to build a house, we'll help take care of the final mortgage on the end. Or if you want to buy a house, we'll obviously help with that as well, or refinance. And we basically offer the whole spectrum of, secondary market mortgages, conventional, like we talked about earlier in the podcast, as well as the 3 government loans, VA, FHA, and USDA. We do also offer some portfolio financing here at American National that's kind of a niche to us. A lot of folks don't, have access to these type products, but we have some niche products. If something just didn't quite fit in the box with Fannie, Freddie, or one of the government routes, but it makes sense, what I call kind of a good old fashioned loan, we have the ability to write those here and to keep them on our books, if it's something that just doesn't fit in the box, if you will, but still
Do you
makes
have an
sense. So,
approximate rate on that, Jeff? Is it prime plus 1%?
yeah, the portfolio rates are not near as competitive as secondary market. The portfolio rates are going to generally be high 6s, low 7s, generally speaking. And just a quick update on rates. I don't think I even gave you guys an idea of where those are now, but I mentioned the government rates are kind of in that mid-5 range for a 30-year fixed. Conventional 30-year rates are around 6.0 for your typical conventional mortgage for a 30-year. And then a 15-year conventional is going to be in that mid-5, 5.5 range roughly. Those are all quotes with generally no points being paid, what we call a par rate quote. So, but that's pretty much, I guess, it as far as what we do. If you want to visit us, online or apply on our website is just amnat.com. That's just amnat.com. And you're always welcome to call or text me. My cell number is 806-773-4311. But love to field any questions any of you guys have.
Okay, that sounds
Awesome.
great. Well, Jeff, thank you for coming back on. It's good to visit with you again.
Yeah, y'all too. Thanks for having me. We always enjoy this. Y'all always have great questions and insight on what's going on, but we look forward to the next time.
Awesome. Yeah, thanks, Jeff. It's good talking to you.
Thank you, guys. Y'all have a good one.
You too.